Imagine the global economy is like a sinking ship, and all the smartest money in the world is violently rushing toward a single tiny lifeboat labeled AI hardware. Welcome to the deep dive.
Yeah, thanks for joining us today.
Right, so today we're unpacking a really dense 2026 Global Market Intelligence report. We're looking at a massive structural shift for you, so global stagflation, monetary divergence, and just some incredibly volatile capital flows.
And just to set the stage before we jump in, our sources today do dive into some pretty politically charged territory, specifically regarding the Trump administration's trade and tariff policies.
Right, and we should make it clear we aren't taking sides or, endorsing any platforms here.
Exactly. Our goal is simply to impartially break down the data and the ideas in the report so you can just see the whole board.
Okay, let's unpack this. So let's talk about this lifeboat. Right now, capital isn't just fleeing the market evenly. It is wildly concentrated,
Yeah, totally. I mean, your everyday cyclical sectors, the businesses that usually thrive when the broader economy is humming, they are heavily stressed right now.
But AI infrastructure is just going parabolic. I mean, we've got memory chip makers like Micron and SK Hynix crossing the $1 trillion market cap.
Right, and Dell is surging, like 33% just on a massive backlog of AI servers alone.
Wow.
Yeah, and what's fascinating here is why that capital is acting so desperate. We are in the middle of a global supply-side inflation shock.
Which is driven by the geopolitics, right?
Exactly. The U.S.-Israel war on Iran and the effective closure of the Strait of Hormuz, that completely upended broad market stability.
So institutional money doesn't just sit in cash while inflation needs it.
Right. It desperately seeks out the few remaining pockets of structural growth, like AI, just to survive.
Wait, I'm a bit confused on the timeline here, though. I thought the Middle East conflict was the primary reason everything got so expensive.
Well, you would think so, yeah.
Because the report mentions they are drafting a peace agreement right now to reopen the Strait of Hormuz. So if that happens, shouldn't oil prices just drop and basically fix this global inflation problem?
And oil actually is dropping back down on that news. WTI crude is at $87.80, and Brent is around $91.54.
Right, so that's good news.
It is, but here is the contrarian stagflationary trap the report highlights. We are entering what economists call stagflation, where economic growth slows down, but prices keep rising anyway.
Because the inflation won't just vanish with cheaper oil, right? It comes down to physical materials.
Exactly. AI isn't just software. It relies on massive, power-hungry data centers that require thousands of miles of physical wiring.
Oh, right. Which means copper.
Yep. While oil is cooling off, copper is skyrocketing. It's forecast to peak at $13,000 a ton.
Wow, $13,000.
Yeah, because the Trump administration has implemented severe structural tariffs. So there's a 10% global duty under Section 122 and a massive 50% duty under Section 232 on essential metals like steel, aluminum, and copper.
Oh, wow. So if I'm building an AI data center, cheaper gas for the transport trucks doesn't really matter if the copper wire inside the servers suddenly costs 50% more.
Right.
It's like oil prices dropping. But someone built a massive toll booth on the only road to the AI future.
That is the perfect way to look at it. Those tariffs act as a toll booth that completely swallows any savings from cheaper energy.
Ouch.
Yeah. Manufacturing costs will keep surging, which the report warns could trigger a severe U.S. economic contraction by the third quarter of 2026.
So if manufacturing costs hit that wall and traditional companies stumble, does that panic bleed over into the crypto markets? Because a lot of retail investors hold crypto as a hedge.
Oh, it absolutely bleeds over. And this is where the mechanics get brutal.
Because Bitcoin recently decoupled from tax highs, right? It broke below $73,000.
Yeah, it's trading at $72,842 right now after $2 billion in ETF outflows.
$2 billion. So what does this all mean for institutional crypto?
Well, right now, the crypto derivatives market is sitting on massive leverage alongside negative funding rates.
Meaning what exactly for the everyday investor listening?
It means institutional players are so terrified of a crash that they are paying a massive premium just to keep their short positions open.
Wait, really?
Yeah, they are aggressively betting against the market to hedge their bets. If that toll booth effect squeezes tech earnings enough to cause a corporate credit crunch, traditional stocks will plummet.
And when institutions lose money there, they get margin calls.
Precisely. And to pay the margin call, they have to sell off their most liquid risk assets.
Which creates a cross-market liquidation event. They are forced to dump their crypto.
Exactly. We could see a brutal rug pull, forcing Bitcoin down to $55,000.
And Ethereum is already losing capital to Solana, right?
Yep, Solana is trading near $80.64 with over $110 billion market cap, basically as investors desperately hunt for any remaining yield.
Wow. Which brings us to monetary divergence. If the U.S. economy contracts that hard and crypto gets liquidated, the Federal Reserve can't just sit on its hands.
Right. The irony is that an economic shock that severe would likely force the newly confirmed Fed chair, Kevin Warsh, into an emergency, panic-driven 50 basis point rate cut.
Just to keep the banking system afloat.
Exactly. We would have the Fed slashing rates in a panic while inflation is still being propped up by tariffs.
So when you look at your own portfolio, this is why spotting these hidden connections is your ultimate shortcut through the noise.
Yeah, it really is all connected.
You can clearly see how a 50% tariff on a piece of copper pipe doesn't just hit a construction site. It squeezes the profit margins on AI servers.
Which tanks tech stocks.
Right, which triggers institutional margin calls and ultimately forces a massive sell-off in your Bitcoin.
It's all a closed loop. A disruption in raw materials inevitably ripples all the way out to digital assets.
Definitely. Which leaves us with a pretty heavy question for you to chew on today.
Uh-oh, what is it?
Well, if AI infrastructure truly is the only financial lifeboat left in a stagflationary world, what happens to the global economy when that single lifeboat inevitably runs out of room?